Morning, everyone, and thank you very much for joining us for this month's 10-minute market forecast. For those of you regular viewers, you'll be very aware I am not the face you're used to seeing grinning out of your screen at you at 10 to 9 on a Tuesday morning, but I'm afraid this month two members of our team have come down by a nasty case of annual leave. So instead of Josh and Jordan, who are both sunning themselves on their holidays, I'm afraid you're going to have to make do with just me this morning. For those of you who don't know me, my name's Gareth Deacon, and I am head of multi-asset here at Blackfinch Asset Management. So let's crack on with a summary of what we're going to be looking at in the investment world in the last month and what we see coming up in the weeks and months to come. Now, I know Josh is very good at summarizing his points in just 3 slides, but today I'm afraid I'm going to break with convention and give you 4 instead. So you may have one less presenter, but you're going to have one more chart to look at instead. So we're going to start with the US-Iran conflict and the Memorandum of Understanding that was signed in June and just what that means for investors. Then we'll move on to US interest rates and whether Kevin Warsh's first meeting as Federal Reserve Chair saw any meaningful changes to the rhetoric from the FOMC. Thirdly, there's the small matter of UK politics. And finally, a brief look at how the concentration risk caused by the AI trade is spreading outside of the US. And I'll touch there briefly on what we've been doing in our portfolios to attempt to counter that risk. First off, let's talk about the US and Iran signing a 60-day memorandum of understanding on the 17th of June. Now, from an investment standpoint, the key element here is that it commits to a reopening of the Strait of Hormuz, which has already seen tankers begin to flow through the strait, and the impact on the oil price was immediate. So the chart that we can hopefully see on the screen here is showing the number of commercial ships that are transiting through the strait. Now, this is delayed, this data from just towards the end of June. But what you'll see that there has been an uptick. It's still going to take some time before we get back to pre-conflict levels. However, this hasn't stopped the oil price from coming crashing down from an intraday peak of more than $126 per barrel to around $72. So now hovering just above those pre-conflict levels. So again, it's come down a little bit further since then. But this is, of course, very good news for investors. It takes away that threat of prolonged inflation and uncertainty over the length of the conflict and returns us to a position that any spike in inflation that may come along as a result of the conflict shouldn't be too long-lived. Now, the agreement is holding, though perhaps a little more tenuously than we would like. But what we have at the moment is an agreement that allows both parties to position themselves as somewhat victorious in the conflict in their native countries, a point that seems imperative to both sides. Now, the deal could break in one of 3 ways, we believe. Iran refused to agree to the terms set out by the US in the talks that follow. The US could do the same if the terms read as humiliating at home, especially ahead of the November midterms, or we could see renewed Israel-Hezbollah fighting, though a June 26th framework eased that risk slightly. We think the agreement holds. Both sides seemingly want to avoid renewed conflict, so an agreement or extension is likely at the expiry in the middle of August. If the deal holds and the strait stays open, oil could drop further, though, as I've already mentioned, most of that war premium is already gone, and that plus lower oil volatility should favour global equities. Now, the GCC and Iranian oil output should ramp up, benefiting Gulf-reliant Europe and Asia, while lower Brent prices obviously ease global inflation concerns. The deal also opens room for a pre-midterm US growth push and has helped to sustain the equity rally. Now, we believe that the risk of complacency here isn't actually in the oil price right now, it's in treating this as if the conflict is fully resolved, which it clearly isn't, and we could still see some bumps along the way. So if we move on to the next topic, and what is in fact a very connected topic, let's talk about Kevin Warsh's first meeting as chairman of the Federal Reserve and what that potentially means for US interest rates. With this being Kevin Warsh's first meeting, the one thing he seemed very much at pains to highlight in his press conference, albeit not in quite so many words, is that he isn't President Trump's puppet. Now, this meeting allowed him to do exactly that, as he could talk about the potential for higher rates due to the inflationary impacts that we've just been talking about, which is against Trump's desire for lower rates. And that way, Warsh was able to say, I'm my own man, I'm going to deal with this in the way I think is right, but not have to actually go so far as to pointing towards higher rates being imminent. The chart you're looking at here on the screen is the Federal Reserve's dot plot. This is a chart that's refreshed by the members of the FOMC 4 times a year and allows every member to provide their forecasts on where they believe interest rates will be at various points over the next few years and in the longer run. Now, what this shows compared to the dot plot in March is that the forecast for the end of 2026 has ticked up from 3.4% to 3.8. The end of 27, it's up from 3.1 to 3.6, and at the end of 2028, 3.1 to 3.4. So while this appears to be a hawkish move from the FOMC, by reporting it in just this way, which many media outlets appear to have done so, it misses some of the important context. Now, as I said, this is votes or forecasts from every member of the FOMC, and every member gets to provide a forecast. But interestingly, not every dot on this chart gets a vote. And at the moment in the FOMC, we seem to have a cohort of non-voting members who are seemingly a lot more hawkish than a lot of the voting members, with one going so far to suggest that from their dots that we should be seeing 3 rate hikes by the end of the year. And this is having the effect of dragging the dot plot higher than it perhaps has any right to be, which has led to some misinterpretation about how hawkish the meeting was. Now, in our view, it is likely the Fed's most hawkish meeting of the year, as inflation is about to roll over, start moving lower as gas prices roll over. And once Walsh has established that credibility, there's little reason for him to act on actually raising rates in a further attempt to prove he is his own man. Now, Trump made it clear his expectation is that Walsh will be proactive on rate cuts and supportive of his pro-growth agenda. And Walsh did suggest that was a possibility in his confirmation hearing back in May. But at the moment, it's looking very unlikely that Trump is going to get his wish for lower rates. But equally, it looks unlikely that we're going to see them go higher from here. If we stay on politics and turn to the UK and Andy Burnham's victory in the Makerfield by-election in June, which alongside Keir Starmer's subsequent announcing his resignation, now paves the way for Burnham to take over as Prime Minister in the very near future. From an investor impact, the biggest factor here is going to be the gilt market. The reality of the world at the moment is the ability for UK leadership to have any meaningful impact on UK equity markets is minimal, certainly in large cap. It may have an impact on investor sentiment, but true impact is being driven by global factors. That is, unless we do see some movement on mandating pension funds investment in UK equities, but we'll park that for the time being. But the bond market is a very different picture. Now, when Burnham was announced as victorious in the by-election, the gilt market barely moved. It reflected the fact that the UK government has no more money to spend and just the predicament that Burnham is going to find himself in. And that's what we're looking at here on the screen. This is the reality of the situation Burnham will be faced with. The chart shows the UK's debt dynamics compared with other developed economies, and it's fair to say it makes pretty grim reading for the UK. The x-axis here showing the effective interest rate on government debt up until 2030, versus the y-axis being the expected annual average nominal GDP over that same period. The UK has one of the highest budget deficits in the G7, and the current plan to reduce borrowing lacks any real credibility. Meanwhile, we've seen successive governments struggling to balance persistently high inflation with weak productivity growth, with the increasingly populist discourse making it harder to drive the necessary reforms to attempt to rebalance that. And as a result, the UK has not yet found a route out of its damaging debt dynamics. So what can Andy Burnham and his team do about this in reality? Now, given the speed at which we've gone from the potential of Andy Burnham running for leader to actually him now on the precipice of about to take over power, it's unlikely that Burnham and his team have a detailed policy package ready to tackle these issues head on the second he takes over. Now, when Burnham was mayor of Manchester, and this is a quote that's been bandied around a lot at the moment, he quoted the UK should not be in hock to the bond market. Now, if he says something similar when he takes over as Prime Minister, he may well be the next Liz Truss. And I think it's fair to say that any new Prime Minister does not want to be the next Liz Truss. He's already tackled that point somewhat by stating that his plans when he becomes PM are going to be backed by the stability that comes from sound public finances and the discipline of our current fiscal rules, which has reassured investors that he's unlikely to undergo a splurge of debt-fueled spending, but all eyes are going to be on the autumn budget when that time comes, and actually who's going to be sat in the Chancellor's chair delivering that budget. Now let's change track completely from inflation and politics to look at something I just wanted to touch on briefly, this final point. It's particularly relevant to our outlook for the next few months. We all know that the AI trade has been dominating the US markets for the last few years. Many investors have been looking to diversify away from this reliance on the continued AI rollout, as some of the US names have hit some difficulties. As a team, you will no doubt have heard us talk about our positioning in emerging markets. It's a position that we took just over a year ago now, or rather it was actually towards the start of 2025, and which has served us very well. But the stellar run that has seen some of these EM names have been experiencing this year, the likes of TSMC, Samsung, SK Hynix, all rallying strongly, the AI trade is now beginning to dominate EM as well, and restructuring just what EM indices look like. On the left chart, you'll see the proportion of each of these the global stock markets that's exposed to the AI trade, with EM now sitting pretty much neck and neck with the US at approximately 50%. Whereas the right-hand chart shows the sectoral composition of EM markets 20 years ago in grey and today in green, highlighting the seismic shift to technology and AI being the key driver for the fortunes or otherwise of these markets. Now, this is a dynamic we've been watching really closely, and while these markets are exposed to different parts of the AI value chain, concentration risk is still something we're very keen to avoid where possible within our portfolio. So, whilst we believe the AI trade still has legs, we think the volatility is going to tick up, and we've seen that just overnight with the moves in the Samsung share price. So we've made a decision to move into active management in the technology sector, reducing passive exposure to emerging markets, which has served us very well, into an active manager that has an excellent track record of positioning their fund well to navigate these periods of heightened concentration and stock-specific risks. So I just wanted to throw that in there as a final nugget to leave you with, as there's been a lot of rhetoric recently about diversifying away from the US into EM from a lot of managers. And I just wanted to highlight that perhaps that diversification isn't quite as diverse as some may think, and that we as a team, as we always are trying to be on the front foot to bypass some of the issues that concentration may throw up. So, in summary, today we've looked briefly at four topics. Firstly, that while the Memorandum of Understanding is an excellent step in the right direction, it's not quite as good as a deal just yet. How Kevin Walsh is at pains to prove he's not Donald Trump's puppet as chairman of the Federal Reserve, and how perhaps the inflationary impact of the Iran conflict is providing him with the perfect backdrop to allow him to do that. We then looked at the challenge that Andy Burnham faces when he takes over as Prime Minister, and I say when rather than if, as I think if anyone else were to find themselves our next Prime Minister, I think it would take everyone by a lot of surprise. And then finally, just a quick look at how the concentration risk in the AI trade is spilling into other markets than just the US, and how managing that we think is going to be vital for the rest of this year. And with that, I want to say thank you very much for joining me this morning and wish you all a very happy rest of the week. Thank you very much.